India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live this Friday morning from the CNBC-TV18 Motilal Oswal studios. Yesterday was perplexing, and I think the question on everyone's minds is, should we read too much into it? Is this the start of another downturn? FI sell number was big, or should we just move on and look at it as a one-day aberration? I'm Prashant. With me, my colleagues Nigel and Surbi. Guys, good morning.
Hi, morning, folks. Morning. One thing that, and for a change, I was actually waiting for that FI number to come. I was checking the exchange again and again. But one thing that this 11,000 crores of selling tells us that this is not a straight line. The behavior, whatever's going on, it's not a straight line. We all wanted to believe that it's over. Maybe not. We'll have to see. But then, hey, thank God it's Friday.
Well, that's right. But I expect, a couple of technical factors were at play yesterday. And I don't expect such large FI selling. So let's see whether or not that happens. But I think yesterday there are a couple of technical factors that play out. And I don't think that we're getting back to those big sell numbers. So December series, time will tell.
No, absolutely, Nigel. And I think that is the consensus as well, that, yesterday was an aberration and you should not read too much into it at all. You speak to people and they say, well, just ignore what happened yesterday and market should be better, market should be good. So we'll talk about that. Now, there's not very much by way of overnight cues to really take forward because last night US markets were shut. So there isn't that to keep us busy. Thanksgiving holiday, so NASDAQ and NYSE bond markets, everything was shut. US futures were trading for a short bit, and I think futures were slightly higher. US investors, I said this yesterday as well in the morning, same time, that they're by and large out for the week now. I don't think any of the larger guys are hanging around to trade whatever markets are trading on Friday. So you've got, in that sense, no US now till we come back next week. And in any case, I mean, activity starts to thin out as we get into December, especially in the second half of December. But Monday onwards, activity should be a little bit better. Now, as I said, US equity futures, small gains. E-minis, of course, also closed early. Cash, of course, was closed. You had European markets which were trading, and some of those markets were up. DAX was up 0.8, CAC 40 was up. That's a German and the French indices about 0.5% odd higher in terms of trade. Other headlines, I mean, there was sort of a comment from the ECB. There was the OPEC meeting, which was supposed to happen. That has now been pushed to the 5th of December and things like that. But these are all marginal headlines, not very much. Yesterday's big fall, and that started at 10:30 when the market just completely collapsed and never really recovered after that, could be expiry-related reversal of positioning and flows which came in earlier. Lots of theories doing the rounds, but that perhaps looks like the most reasonable sort of explanation out there. We'll get into this in greater detail in a bit from now. And the consensus is not to read too much into yesterday's price action, that this is not something new which we are starting. I mean, you look at a $2 billion net sell number from FIs and you start to worry. Well, that is not the way to read into yesterday's price action. So just want to make that clear. Now, levels which have not really changed. I mean, we've been in this range. The high has been for the last 4 sessions around 24,350. Instead of breaking out on the higher side, the market just broke down on the lower side. That's essentially what happened. So the 24,350 number, that coincides with the 40-day exponential average. That has been elusive. And 4 days, actually, all of this week we've spent knocking at that and then collapsing. Yesterday was no different. With yesterday's sort of cut on the Nifty, we've erased the Maharashtra election gap up as well. So Friday was, between Friday's close and Monday's gap up, there was that big gap, right? Because the election results came over the weekend. Yesterday, we've overlapped a Friday's high. So the gap is between Friday's high and Monday's low. And we've kind of overlapped. We've sort of filled that gap in that sense. What are supports now? You got to go back and look at some very near-term levels. So 23,800, 808 and 23,860. What is this? This is the 50 and the 61.8% retracement of the recent rise from the lows last week to the high this week. Just, 4-5 days, not even that. So this 50 and the 61.8% are these numbers, and these are the near-term supports that one should watch out for. So just 100 points away. And I think we're in that kind of a market. For the Nifty Bank, let's just put the levels out as well. The supports come in the zone of 51,271 and 51,774. This is the same gap area, which for the Nifty we filled, for the Nifty Bank we've not yet. So the support comes in that zone, and near-term resistance stands at about 52,760. This is the recent high that we saw, yesterday's high, by the way, that we saw for the Nifty Bank. So, those are some levels. The GIFT Nifty will come up on your screen. A lot of individual stock-specific action that we want to get to, and I think that's where the real bulk of the activity should likely be. Remember, it's anyway the end of the year. On top of that is the Thanksgiving weekend. Global activity, etc., in terms of volumes will be very, very thin. So be mindful of that. 36 odd points higher on the GIFT Nifty. Surabhi.
Absolutely. Asian markets are fairly mixed right now. And for us, through all the early part of the week consolidation, yesterday's fall, all things put together, we are flat for the week on the Nifty. So let's see. Friday promises to be an interesting session. Which way will the scales tip? Now, to talk about some of the data points that we have from Asia. Tokyo inflation numbers are out. And why is Tokyo inflation important? Because it's a barometer of, what is overall happening in Japan. And that will lead us to the BOJ policy action. And it seems the expectations are that a BOJ rate hike is not off the table, because those numbers are looking a little hot if we talk about the print that came out. So Tokyo inflation is at 2.6. It was at 1.8% in October. So a bit of an increase has come through. The core inflation hasn't moved up that much. This is more about, I think, fuel and food prices. Anyway, markets across Asia are mixed. If you look at the hot boards now, so the Hong Kong market started positive, but it's faltering now. The Japanese market is okay. South Korea is down a bit as well. We've got industrial production data out of South Korea. It's not looking too great. So that market's also on the lower side. On oil, now geopolitical risk premium is very much back. The flashpoints, both Ukraine, Russia, there's been enough going on there with Russia attacking some of the energy infrastructure in Ukraine. And the headlines out of the Middle East are also not comforting, because there are repeated reports of a breach of the ceasefire agreement between Hamas and Israel. So oil is back up to about 73 thereabouts on Brent. That's a watch point. Now let's come home and look at this whole FPI business, the number that we're talking about, large sell number coming in, 11,750 crores. Now, technical factors, yes, it was expiry yesterday. We have to see how this plays out. Then you're getting into the end of the year. Yesterday, it's a big number, and the bulls will hope that this is a one-off. It is not a sign of more such selling to come, because we've had enough of this in October and for the bulk of November as well. Domestic institutions were buyers. Imagine what the market would have been without the support of that 8,700 crores of buying that came through. Anyway, in terms of action today, lots of F&O, and we will talk about that because there are 45 new stocks getting added to the F&O tally from today, and it includes a lot of the new age company names as well that were not available to trade in F&O. More coming on this in just a bit. Life insurance as a space will continue to be in focus, and we'll tell you more about this, because what did the insurers say to the story that we put out yesterday? That, look, if it is IRDAI and if there is any major policy change that has to be announced, it's usually through a consultative process. So the insurers are keeping the faith that there'll be no knee-jerk regulatory change with respect to the bank assurance channel, which is huge for these insurance companies. So let's see if there's any recovery from yesterday's slam dunk. Yesterday, the stocks were down 5-6%. Last but not the least, watch out for Z. Now, this is not going to materially change anything, but yes, the news is big. Shareholders have said no to Mr. Puneet Goenka, not even to be a director. So he's not, managed to get that approval. But just a couple of days back, Z told the stock exchanges that Mr. Puneet Goenka is going to be stepping down as MD of the company. He will only continue in the capacity as a CEO. So materially, it doesn't really change much, because I think this was anticipated, which is why he decided to step down from the MD's position. But it's a story that could keep the stock in focus today. So plenty to go through over the day, Nigel.
Well, we're almost into December, and the big question is, will Santa come to town in 2024, December 2024? I'll tell you what, last year he came in with a bang, because last December we had a big Santa Claus rally, and in fact it was even better than 2020 when you had the index that was up close to around 7%, but last year it was even better. The December series, we were up close to around 8% or thereabouts. And this after the last couple of series haven't been so great. Remember, October was a downer. November, we wanted to see a bit of a pullback. Initially, we saw that, and then we saw a sharp decline as well. But if you want to look at a bright spot, then in fact you'll have to look at the, at the Nifty Bank. Nifty Bank, in fact, for the past series itself, that was a bit of an outperformer in last series. Moving to the other couple of data points, then the rollovers. The Nifty bank rollovers, that's been higher than the average, while the Nifty rollovers, well, that's more or less in line with what we have seen. Now, the open interest at the start of the series is something that we normally look at. And at the start of the December series, the total open interest on the Nifty, it's a little bit higher than what we saw at the start of the November contract, but it's still far away from what we saw at October. So it's relatively heavier than the past series, but in comparison to the previous averages, it's not so heavy on that front. What about positioning? The FIs as well as the clients, they have been on opposite ends of the spectrum. And this time around as well, it's not too different because the FIs remain short, but they're not as short as what they were at the start of the last series. And the clients, well, they remain net long. Even in the last series, they were net long. Yet again, they're net long close on 2 lakh contracts on the index futures is what they're net long. Remember, they got it right in October as well when they were net short on the index and the markets did pull back. So I think the clients are still bracing for a bit of a pullback and they have been the ones that have been getting it right. So I don't rule out that December could actually be a far better series in comparison to what you've seen in the last two. On stock futures, they're both on the same lines. As we have seen in the last few series, of both the clients as well as the FIs, they're net long on stock futures. So individual stocks will continue to do well. Coming to the levels then, the last few sessions, I think for the last 4 sessions or thereabouts, this 24,350 mark has been a problem point. And just take a look at it. These are the highs that we have seen. So if we're looking at the resistance, well, this is the resistance, 24,350. Near-term levels that you're looking at, well, the immediate level will be the 20 DMA. We ended below that level in yesterday's trading session, so that's going to be crucial, around 24,000 odd. We're seeing some green to kickstart trade, but you'll want to get past that, so that's going to be important. While the next level is the 200 DMA. Remember, in the past series, we went below the 200 DMA for the first time in more than a year and a half. So that's the important mark you're looking at. The Nifty Bank, as I said, for the past series as well, it was a relative outperformer. Very, very crucial levels come up for you on the screen. You'll want to see defend all these levels and, in fact, make a fight back. So the Nifty, well, it will be dependent on the Nifty Bank. That's the one that could lead from here on. And in terms of stocks that we're looking at, more fun and games because you have more number of stocks that will be available in the F&O market. And a few of them should come up for you on the screen. 45 scripts in the F&O market from today itself. And Zomato could be a stock that you're going to be looking at. It's going to be in the sensex. Now, in fact, it probably could get included in the Nifty as well. Another couple of names like Avenue Supermarts, Geo Financial Services, as well as Paytm, that's actually seen a big rally. So keep an eye out on these clutch of stocks.
Nigel, you're talking about Santa. Do you guys see that story? Santa's complaining of no snow in Norway, one of those Nordic countries.
Global warming.
Did you see that picture? He was sitting, Santa with his red hat. He was sitting there saying, well, not a flake of snow. I mean, that was...
Is that a meme or is that for real? I don't know. I haven't checked Norway's weather.
I'm assuming it was kind of just exaggerating to make a point that climate change is real. But I mean, something to watch out for. Well, Rohit Srivastava is with us, founder and strategist at IndiaCharts.com. Rohit, good morning. Good to have you with us here. Thank you very much for joining us bright and early, Rohit. So good to see you. Rohit, so the question is, I mean, big reversal yesterday, big FI sell number as well. How much should we read into it in terms of taking forward, what happened yesterday as the beginning of something sinister, or you think we should just kind of ignore it as a one-day aberration and look at things more constructively? What happened yesterday, if you have any data, etc., and then road ahead? Go on.
So, yesterday was the monthly expiry, and usually on that day, we do see very big FII, DII numbers. So we can't really look at that number and take a call. And even if we go a little broader, we know that when there was FII signing and the market was going up, we were giving all the credit to domestic institutions for their buying. So really, when the market is down, to give all the credit to FIs for their selling is probably not the right approach to analyzing this market. Otherwise, you would get it completely wrong. So what we end up doing is looking at sentiment, looking at positioning, and what is really happening to understand this market. But one thing that I'll say, one conclusion that we are coming to is that we are not done with as far as the correction is concerned. Having said that, no market is going to fall one way. And I think after a 2-month fall, we were attempting a bounce back. And I'm not sure that bounce back is over. It's probably still got some legs to go. And this is seasonally a better period than September and October. So September, October, because of the seasonality also, we were expecting a pullback. We got much more in India than we got in global markets. Now, usually this is the year end where you typically get some improvement in markets, and that's, I think, the setup. Yesterday's fall does go below the 20-day average, but still above retracements, even though it's filled the election gap. We can still call it potential higher low in development once we get it. Either it's done yesterday on the expiry day, or worst case scenario, if it does dip, then we'll keep it open till 61% retracement, which is a little lower. But I think we should be headed up to around 24,770 which is a minimum, and possibly closer to 25,000 overall in a counter trend bounce. So I'm saying it is a counter trend bounce. We may eventually see selling pressure again build up as we go into Jan, Feb, March, because again, that is another seasonally weak period for markets typically. And so I'm not really looking at a new high, but it could happen in individual stocks. The mid and small cap indices have held up better than the Nifty itself. So that does raise the possibility that they still do better for the time being. But again, on the Nifty itself, we don't see new highs. So that is the big divergence in the overall setup, which means that eventually we may even go below 23,300, but not right now, not right away. Right now, I think for traders at least, or in the short term, we should be looking at going higher from here and not lower. Another data point, as you said, supporting this, a couple of data points, in fact, are the shorts that have built up, right? There's a lot of shorting in this market that is going on. And we've seen that in the FIA positioning that you were talking about. We saw some short covering yesterday, but it's still a meaningful short position out there. So it's not completely reduced in the market. In fact, out of stocks, one of the interesting reads which I put out yesterday is actually on Reliance Industries. Reliance Industries has the potentially highest short. I say potentially because we are, of course, looking at only open interest data.
Rohit, we'll just come to Reliance in just a bit. I want to just wrap up the Nifty point. So you're saying, so the path of travel in the very near term is higher, just to make that clear. Probably it's higher, right? 24,770 and then 25,000 in a counter trend bounce. But you're also raising the possibility that maybe the correction itself from the September highs is not fully over and that we'll have to deal with at some point. That's essentially what you're saying, right?
That's right, correct.
Okay, got it.
Okay.
Yes.
Rohit, hi. Morning. Now, I don't remember the year, but I definitely remember that it was one of those Decembers where we thought everybody was going to go on holiday, but they didn't, and there was a fair amount of FPI action and a lot of volatility and selling as well. I think it was just after COVID or just before COVID. Short point is that I wanted your thoughts on what specifically happened yesterday and whether this cash market selling of 11,000 crores, I mean, would you ascribe any separate technical factors beyond the fact that, of course, it was expiry day, and whether there's any way of further guessing as to what lies ahead? Because we all wanted to believe that the bulk of this FPI selling is over. It had come down to a trickle in the last couple of sessions, and then bam, you get 12,000 crores sold in one day.
So like I mentioned, we have seen this expiration after expiration, that on that day, the FPI selling is always higher than on the other days. And I think it has to do with arbitrage unwinding. It's a very simple equation. If you're long stocks and short futures, right? If you have done that kind of a trade, then on the day of expiry, your futures are closing out. And to the extent that you have cash positions open, which you have not been able to hedge into next month futures where you haven't rolled over, you are going to have to square up that extent of position. So that means cash selling always comes in on expiry day. So you can check back, you'll always find the expiry day cash selling by FI is always being higher than normal, going back, for a couple of years also. So that is why the data point that we are looking at yesterday, 11,000 crores, may not be something that you need to look at and get worried about. What we really want to see is what happens today, what happens after expiration and the rollover and square offs have happened. Do you really see continuation of that selling? And do you see the mid and small caps give up? Because if you actually look at the last two very short-term peaks that we saw, one we saw on, say, 15th of October, another we saw on the 6th of November. Both of them, the Nifty was not able to bounce very far. But the mid and small cap indices did go up a lot, and then they started to sell off from there. Yesterday, we haven't really seen selling in the mid and small cap indices. They both closed positive. So unless you see weakness in the broad market, I would think that, it's again a one-off that what we've really seen yesterday. It's not giving us the same behavior that we saw in the last two occasions.
All right. Hi, Rohit. Good morning and good to see you, Ben. So I think consensus is correct. We started the show that's saying that maybe, in fact, that FI selling is not something that we should see. And it appears that, that seems to be your understanding as well. So good to see that. But you were making that point on Reliance, and the open interest surge that we've seen out there. That's been the bear's favorite stock of late. Stock has corrected, underperformed the markets as well. But in the open interest build-up, what are you observing and how do you expect things to pan out from here on?
So this is the highest open interest since 2006.
Yes.
And it's been pretty much one way up on the OI chart, even as prices were continuously falling for Reliance Industries. It's been a relentless sell-off, I think, over the last 1.5 months. And what that usually means, because it is an inference, we don't have the long short breakup. So the inference that we make is that if prices are falling and OI is rising, it's possibly got to do with a lot of short selling. Okay, so it's the inference essentially means that if there's such a big short built up, any kind of reversal in price would result in a lot of short covering. Whether it's just price action or whether it's news based is something we'll of course have to see. But there's a case that any turnaround could drive short covering in the stock, and that's something to really watch out for.
All right. So, but do you think that is likely to happen? At around 1200, 1220, we have seen the stock bounce off those levels, Reliance Industries. And if that could come to the party, it'll be very, very good news for the bulls' perspective. So we'll keep an eye out on that front. Rohit, a couple of more questions on stock-specific action. You have more to deal with now because you have 45 new F&O stocks that will be coming in there. Any interesting price action that you're looking at? Zomato has been looking very, very good. Paytm out of nowhere, in fact, has looked good. I've seen this in the past, Rohit, and you will recollect as well. Stocks like Just Dial and all, they came into the F&O market. Everyone thought they're going to run away from there. And from there on, they became the biggest shorting candidates once they came into the F&O market. This time around, any specific stock you're looking at? 45 have been added to the list.
So without really naming a particular stock, what you said is very true, because it's purely psychology, right? We end up recognizing a company based on its past record. And when the record has been good and the stock has done well in terms of performance, we bring it into the futures and options segment, and from there sometimes the performance is not as good as it was in the past. So this has got a lot to do with mass psychology than anything else. Having said that, I'm sure it's not always the case. I mean, in early stages of a bull market, stocks that got included probably did well as well. So where we are in very, very late stages of a move, there's the potential that you have a very different outcome. Now, having said that, if we try to look for winners in this kind of a market, it's not going to be easy, because on days when the market is down, like yesterday, you might find many stocks making new lows and you end up getting caught in that. So I'm again repeating, this is to us still looking like a counter trend bounce. We are not really looking at new highs. That means the chances of getting stuck in stock specific moves is very, very high, which is why we'll probably not take a stock specific approach at this point of time. In fact, be more worried about when the next sell-off will come in, and you end up seeing much lower prices. So very tough call to really take at a stock specific level.
So a bit more defensive in terms of overall approach to things, and not going all out. So that's an important thing: counter trend and not trend. And when the overall bigger trend overwhelms, we'll have to see. Two other things. Anything from a global macro? Quick one, Rohit, which is important to track. Anything moving?
So the good part, the good part is that bond yields are probably starting to head lower again as far as the US is concerned. Unfortunately, we don't have the same clarity on Indian interest rate cycle, though bond yields in India also have been slightly off. But the currency, which is USD INR, is so close to an all-time high that I really doubt that the RBI can pull a rate cut on that. So that's where the global setup is. The dollar, though, still remains strong. So we have this contradictory move between a rising dollar, but at the same time, you have rising bonds. That's slightly deflationary, which is what we see in commodity prices, which is why even taking a bet on, say, the metal sector is slightly difficult at this point of time.
All right, Rohit, we'll leave it there for this morning. But great conversation as always. Thank you very much. And I look forward to many more at 8 o'clock. Thank you. Have a good weekend as well.
Yeah, this was nice. Count on us to call you again and again, Rohit. But that's really reassuring to you, reassuring to hear that explanation that this large FPI number is probably only technical in nature because of the expiry, the monthly expiry yesterday. Maybe we don't have to get so worried about it. Let's move on then and tell you what else is lined up on the show today. Lots of corporate interactions coming up as well at 8:30. First of all, we'll have Siddharth Khenka of Motilal Oswal joining in. We'll discuss the technical setup of the market. What about fundamentals and what are the stocks that you can focus on today? So we get down to it. At 9 a.m., we'll have Manas Agarwal of Bernstein joining in this big debate around whether the bank assurance channel is going to be tightened up for life insurance. I mean, it all started with the FM's comment. Stocks are falling yesterday. What's the Bernstein view? We'll tell you in a bit. At 9:20, we have Devina Mehra joining in. She is our market master of the day. We'll get some perspective going with her. At 9:30, we chat with Sheila Foam. We talk to the management about demand trends and the expectations for the second half. After that, Srinivasan Varadarajan of Union Bank of India will be with us. We discuss the business momentum and the trends on both the lending side and the cost of funds. And at around 9:50, we have Saurabh Gupta of Dixon Technologies joins in. Motilal Oswal has gone quite bullish on this stock. So what are the business expectations? What's happening on the ground? We'll get a check going with Saurabh Gupta. And then on It's the Economy today, Lata will be in conversation with Pranjal Bhandari of HSBC to discuss their expectations from the GDP data that is due today.
Well, time to slip into a short break, but on the other side, we'll get into stock-specific action. All the top stocks in news are waiting for you. Stay with us.
Welcome back. So the cues are all right. I mean, it's a little mixed across Asia, but the implied open is giving us hope that we'll start off positive. So let's see if we can recover from yesterday's fall. Lots of stocks are going to be in news as well. So let's straight away get to it. We have our team standing by with the list of top stocks to watch this morning. First and foremost, Nigel, these F&O inclusions, 45 new boys and girls in the house.
Well, that's right. It was announced, a few days ago. And from today onwards, the 45 new stocks will be entering the F&O bracket to trade in. And as of now, you had close to around 178 stocks that were already trading in the F&O. Now, to that list, you'll add close to around 45. And some of the notable entrants were Jio Financial Services. You have Zomato as well as Avenue Supermart. So we'll have to keep an eye out on all these stocks. Zomato, because it's probably a nifty inclusion once they come up for their inclusion criteria. Towards the end of January is normally when we see. And we know the industry has got a bit of a tailwind with it as well. For Avenue Supermarts, I'll be interested to see what happens out there, because we know valuations are rather expensive. So let's see whether or not some shorts pile on to the system, given the valuations, given the way business is shaping up. The other notable inclusions will be some of those Adani Group stocks, Adani Energy Solutions. The stock is corrected big time from the top. In fact, it's one of the stocks that is still below the Heidenberg low. So we'll have to keep an eye out on that one. Adani Green, APL Apollo Tubes as well, and Adani Total Gas. Some of those stock market related plays as well, whether you look at CAMS, CDSL, BSE, Angel One, all of them come into the list. And a few more to wind this down. We have CGPA, Delivery, Hoodco, IRCTC, as well as Nykaa. So keep an eye out on all these names. Just thought we'll put up a few for you on the screen. For me, Zomato will be top of mind from here till January end, because that's got the industry tailwind, and now it's in the F&O list, so it gets eligible for a nifty inclusion.
All right, Nigel, thank you very much for that. So let's keep an eye out on these names, F&O additions coming through to the market. Well, more stocks with news flow. Vamakshi is here with details. Vamakshi, morning.
Good morning, Prashant. Let me first start off with Zee Entertainment. The stock will be in focus because shareholders have rejected proposal to reappoint Puneet Goenka as the director of the company in its AGM. The proposal was defeated by a 50.4% vote. Now, keep in mind that earlier, the proxy advisors InGovern and IIAS both had recommended that shareholders should vote against his reappointment. And in fact, a couple of days ago, we did see Puneet Goenka step down as the MD of the company in order to, concentrate on the activities as the CEO of the company, and therefore he will still continue to hold on to the reins of the company as the CEO. Apart from that, keep an eye out on Reliance Industries. Reliance Finance and Investments, a step-down wholly owned subsidiary, has entered into a stock purchase agreement with Wavetech Helium Inc. or WHI. This is a US helium gas exploration and production company. They will be acquiring nearly 21% stake in the company for $12 million. Fine Organic is another counter we will be watching out for. on. That is because they've resumed manufacturing operations at their plant situated in Badlapur from November 28th onwards, after it was earlier disrupted on account of a fire incident that took place a couple of months ago. They are actively working on fully restoring all other plant activities to normalcy, and in addition to that, they also mentioned that they received an on-account partial claim amount from the insurance company. PCL, watch out for this one as well. That is because they've commissioned second and final phase of specialty chemical capacity at their plant in Mundra, Gujarat. With this, the combined manufacturing capacity of the company stands at 7.9 lakh MTPA. Lastly, let's watch out for Newgen Software as well, because they've received an order worth 37 crores from the RBI, and this is for regulatory application management system. So overall, these are the stocks that we will be watching out for.
Okay, and thank you very much for that, Vamakshi. In that list, might I add this NCC order win? It's huge for the Ken Betwa link project. It just flashed on the screen right now. Just pulling up the details from the exchange. So there's a dam and, all kinds of related construction work. 3,389 crores. I mean, almost 3,390 crores is the value of this project. It's a big one for NCC. So perhaps need to look out for this one as well. All right, with that, let's quickly move on and go across to Manisha for all the currency and commodity market action. Manisha, good morning. So what's top of mind?
Well, after days of conversation between Israel and Lebanon coming to a ceasefire agreement, what we hear in the overnight reports is that Israel and Lebanon are now accusing each other of ceasefire violation, and that's exactly the reason you have seen the crude oil prices gain up a bit. The other thing is the OPEC and allies have delayed their 1st December meeting now to 5th of December to avoid conflict with another event. OPEC and allies, in any case, are likely to extend production cuts, so that's what the markets are factoring in at this point in time. In the metals as a sector, we'll see some support come back in case of gold and silver. Remember, the trading is thin with the U.S. Thanksgiving week going on. In the metal space, we've seen good comeback for zinc, which is trading at a 4-week highs. Lead is trading at a 5-week highs as well at this point.
All right, Manisha, thank you very much for that. So that's precious metals and commodities in focus. We take a very quick commercial break here. We're going to come back. Siddharth Khemka, Head of Research, B&D at Motilal Oswal Financial Services, is going to be with us. We'll put some stocks to him on the other side. Stay with us.
Welcome back. Hope you're having a good morning. Well, we start off a new series today, which is the December series. So let's discuss a few stocks with Sid Khemka, Head Retail Research at Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Good morning and good to see you. Well, we've got some news that just flashed for our viewers on the screen. NCC, they won a big order, 3,300 crore rupees, which is large enough in size. What's your view on the stock? And if you have a view on any other stock from the sector, or you prefer to play it via NCC?
Yeah, good morning, Nigel. So thanks for inviting me here for the show on Friday morning. If you look at the expectations post the Maharashtra election was that the construction activity or the spending capex activity will increase going forward, because H1 we had not seen much of activity, and especially from the government side, NHI orders have not been there. So the activity would go for sure increase going forward. NCC, somehow we don't have coverage, but I think it's a very positive development. Some of the other companies in the space, if you look at on an overall capex theme, KEC International is something that has been consistently getting orders in the transmission and distribution side. That is something that we kind of like a lot. Larsen is a preferred pick to play the entire capex theme, be it on the construction side, be it on the capital goods side. We believe that with the increasing capex spend, both from the government as well as from the private capex cycle, so that should be positive for Larsen. What has also helped Larsen is that the global order book has been pretty strong. Global business has been strong, and the domestic business should now see some recovery. And that is something that should drive growth for Larsen going forward.
No, absolutely. I get that. Just a quick word on, two areas, Siddharth, where we saw a fair bit of price action. One is all these defense names. Even yesterday, if you look at the PSU defense, that index, it ended higher within in a market which was actually down sharply. Cochin Shipyard, BEL, of course, has been outperforming, and a bunch more, BDL, etc. What do you like there, Siddharth?
Yeah, so Prashant, if you look at the overall defense space, fundamentally things have not changed much. What happened over the last couple of months is that valuation-wise, things had gone a little bit over the roof, and that is what kind of consolidated, and we saw the correction mainly on the valuation front. In terms of results, we see consistent delivery from most of the defense players, be it the Bharat Electronics, HAL, Mazagon. So what we believe is that, again, H2 is generally a better quarter for the overall capital goods defense space. Q4 is the strongest quarter that we see for most of the defense players. Within that space, we like Bharat Electronics, which is our preferred pick. We have a buy and a target price of 360 over there. We also like HAL, which is a market leader in the aeronautic space. Plus, Mazagon, I think valuation-wise is now very comfortable. It's a leader in the defense shipyard. And if you look at the results, Q2 has been very strong numbers. Valuation-wise, also on a forward earnings basis, we see 30-35 times price to earnings, which is much comfortable compared to some of the smaller names, which we believe are trading at a higher valuation. So in terms of comfort, growth, as well as valuation and earnings growth, we like BEL, HAL, and Mazagon.
Got it. All right. Sid, what about the Swiggy versus Zomato argument? Both seem to be doing well. Swiggy, in the IPO, not too much interest. They left some money on the table. Kudos to the promoters as well as the bankers for that one. And the stock has given you a quick fire, 20%. Your view and the choice between both of them?
Yeah, I think, Nigel, it's an interesting debate once both the companies are listed. So earlier, we only had a choice of Zomato, which was doing well. The only difference that I see is that while Zomato has already turned profitable, the path for profitability for Swiggy is still some time away. Based on our estimates, we are expecting the company to turn profitable only by FY27. Nonetheless, growth in this segment is pretty strong. Both have raised capital. Swiggy through the IPO, Zomato through the recent QIP, it has raised 8,500 crores. Blinkit has been doing very well. Swiggy has regained some market share, but if you look at the entire space is heating up. Zepto has also raised money. Some of the other large players, Big Basket, Amazon, Flipkart, they have all getting into the quick commerce space. So exciting times ahead. But for now, we believe that Zomato is our preferred pick in the between Swiggy and Zomato. We will go with Zomato. We have a buy rating, target price of 330. They have also unveiled the District app, which is the one-stop destination for the going out theme for them, which we believe again could play out in a big way over the next few years. The 8,500 crores QIP that will help them in aggressively expanding the Blinkit operations, adding new stores, warehouses. So overall, we see it's a full package of growth. And current valuations are still comfortable given the growth and the company which is already turned profitable. So Blinkit would also turn profitable. Cash generation is pretty strong. So we'll go with Zomato with a target price of 330.
Okay, so Zomato over Swiggy. Got it. Siddharth, stay on. We'll come back to you for some more questions. But in the meantime, let's get to an exclusive conversation. Air India CEO Campbell Wilson says the revival of the airline will be the Everest of corporate turnarounds. Speaking exclusively to CNBC-TV18, Wilson also sought patience, saying that the management will need 5 years to get the airline back in shape. He also said that the ambitious plan to upgrade the legacy fleet will take more time and cost than the budgeted $400 million. Take a look.
The investment that we're making in turning around Air India is significant. It will take some time to turn around the airline from a financial perspective, but I think if you look at our reports, we are making very, very good progress. And so I think we always said that this would be at least a 5-year turnaround. There was a reason why we said that it would be a 5-year turnaround. There was a reason why the economists said that it was the Everest of corporate turnarounds. I think what we've achieved in a little over 2 years is significant. It's certainly not finished. We are as impatient as anyone to bring it to closure, but I think progress is occurring. We committed more than 400 million to the retrofit program back in 2022. We also selected the seats back in 2022. There is a regulatory design, certification, and then subsequently manufacturing process that we need to go through. And that is where the supply chain constraint has hit us. The 787 aircraft, the first of the retrofit ship sets will come in April. It'll take a few months to install and be certified. First aircraft hopefully in service by October next year. The 777s will have a refresh next year, but then go for a full retrofit starting in 2026.
So that 400 million that you spoke of, that was committed as far as the retrofit program was concerned. Do you believe you may need to now allocate more capital towards the retrofit exercise?
Well, the sad fact is yes.
We're going through a second phase of consolidation. The last one we saw was in the early 2000s or the mid 2000s. But what does that mean in terms of pricing power for airlines like yourself? And also on the back of the merger and the integration, what are the cost efficiencies that we're talking about? I mean, what does that realistically mean in terms of margin improvement for Air India?
Well, there's a whole regulatory and legal structure that you need to maintain if you're an independent organisation or an independent airline. There's duplication of many positions. There aren't the economies of scale that you can enjoy when you're a 300 aircraft airline. So clearly there are efficiencies, and we've realised some, and there are more that we wish to realise. And that was part of the motivation for putting the businesses together. But I wouldn't want to give you particular figures. With respect to pricing power, I'd refer you to an article that was literally just released by IATA, which traces how airfares have tracked relative to the CPI and relative to oil prices, not just in India, but in many countries. And what you will find that if you index back to 2015 or 2019, airfares have gone down. And not only gone down, but gone down dramatically relative to inflation and relative to oil price. So I think just the competitive dynamic of aviation and the market will mean that airfares will remain affordable, and of course we want to fill our planes. So there's always going to be a benefit to the customer in that respect.
All right, that is Air India and its turnaround plan. We'll take a quick break on that note. Up next, we have our technical experts joining in, Mitesh Thakur and Shrikant Chauhan, to help us understand the trade setup for today and some trading ideas as well.
Welcome back. Well, yesterday we saw a downtick. It could be expiry related, and maybe the probability of us seeing a bounce back from lower levels could be rather high actually. But let's get in our technical guest. We have Mitesh and Shrikant who join us. Good morning, gentlemen. It's a Friday. Get through today and then get into a good weekend. But for the time being, our viewers will want to know, Mitesh, how do you trade the index? Buy into that dip we saw yesterday or stay away?
Good morning, Nigel. The weekend would have been good except for the last 2 hours yesterday, which kind of changed the... So I think, one, getting below 24, 150, 120 zone was a slight negative. You've kind of, violated the pivot which was holding this bounce back. And therefore now capturing it becomes very important, and therefore any fresh long bias should be taken once we see the Nifty stabilize about 24, 150. What could happen negative on the downside is if we see the Nifty break 23,950, then there's a good chance that the index might actually, head towards levels of 23,800, and in the worst case scenario, even 23,500. So we'll keep a watch on the index that way, hoping that this 23,950 pivot holds. It was, it actually Nifty just managed to close below that, but the opening gap up, should be good and should provide some support. So yesterday's low can be taken as a fresh pivot. Having said that, I think, the other important factor was that on the upside, 24,350 on the last, for the last 4 days, which is the entire week, has been registering intraday highs. So I think a bigger trend change will happen once we see 24,350 being taken out. Till then, I think it will be a slightly choppy market with a mild negative bias.
Okay, all right, Mitesh, got that. Let's bring in Shrikant as well. Shrikant, what is your sense? Big scare yesterday, but we've been speaking to a lot of experts, technical experts, F&O experts. They're all saying that it was expiry related. Don't get worried. Anyway, levels and index strategies for you?
Good morning, Survi. Good morning, Nigel. Yeah, it was like scary because it was not expected that the market can break the level of 24,000 so easily, but it has broken that. Also, on the other side, if we see the overall trend of the market, which was like a lot of under pressure, and the rally of 1,000 points was like just a pullback. So we were expecting some correction, but it was not expected to the line. Yes, there is a possibility that we may see the levels of 23,800 or 850 in today's date, and I am of the view that close to this 23,800, the market should find some support and again rebound. So broadly, I am of the view that we should look for taking some contra bets of going long close to 23,800 with a stop loss at 23,700 on the downside. Excuse me. Also, Bank Nifty is also around its important supports of 51,800 and 700. So there we can see some support, but broadly, I am of the view that we need to focus more on the Nifty around 23,800 for taking contra bets. And again, we can expect 24,050 or 24,150 on the higher side.
Okay. Well, let's just get the trading specific ideas out as well. Gentlemen, morning. Mitesh, what do you have?
Yeah. Good morning, Prashant. I have a mix of buys and sells today. On the buying side is Exide, keep a stop below 450 here, look for target of 470. And is L&T Finance, buy here with a stop at 142 for targets of 150. And both these sells are conditional. I think, if they see continuation below yesterday's low, then Tech Mahindra will be a sell. So sell below 1705, look for targets of 1665 and keep a stop at 1722. And similarly, HDFC AMC, sell below 4180 with a stop at 4225 for targets of around 4080.
Okay, and Shrikant, stock ideas?
Yeah, I think in this uncertain sort of trend, we should look for adding or taking bets on those stocks where there is like some event or something like related to the news flow. We like Zomato, which is around some 285, 284 levels. There we are expecting further more upside in the near term. It is around 286, 284, but if we see any upward activity in the stock, then the stock can easily cross the levels of 300 or 315. So it's a buy at current levels around 286 with a stop loss close to 277. And we also like DMart, which is around 3,700 levels, and multiple times the stock has taken support close to these 3,750, 3,650 levels in last 1.5 years. So it is very close to its long-term support levels, and today's inclusion in the F&O may add some more momentum in the stock. Broadly, I am of the view that we should look for taking some positional view on DMart at current levels with a stop loss close to 3,600, and we can expect 4,000 sort of level in next few days or weeks.
All right, gentlemen, we'll leave it there. Thank you very much for joining us with that perspective as far as markets go. We'll take a quick commercial break here. We'll be coming back on the other side. We put the focus on the insurance space. The CNBC-TV18 exclusive yesterday. And we'll get Manas Agarwal of Bernstein to put the focus on what he made of it on the other side. Stay with us.
The pre-open rates are just trickling in, so we'll get more concrete numbers just in the next few minutes or so. For the time being, let's welcome Avni Bhatt, the Senior VP Equity Derivatives Research at JM Financial Services, who joins in. Hi Avni, good morning and good to see you. And as always, we're kickstarting a new series and we're just making this point earlier. The bulls are longing for Santa to come along. And last year, he did arrive. 7% rally is what we saw. Do you think a relief rally is on the cards? I think that was on the cards. The problem is yesterday's close was a bit iffy. Your take?
Good morning, Nigel. Yes, I believe the Santa is going to come in this particular month and probably in the second half of the month. So just going by the time series analysis, I think we still have 1 week to about 8 to 10 days still left for the time correction to happen within the range of 23,750 on the downside and 24,350 on the upside. So post that, I think we need to give around 7 to 8 days to the market. And post that, we should be seeing a good short covering rally. And by later half of the month, we should see long build-up also coming in. So Nifty is heading towards around 24,800, 25,000 in this month. Bias has to be on the positive side. Similarly, for Bank Nifty, 52,600 is the resistance level. Once that is crossed, and Bank Nifty gives a close above that, then we are heading straight towards around 54,000 to 54,500 mark. The supports to be watched out for 23,750 on Nifty and 51,300 on Bank Nifty.
Got it. All right. What about top picks?
So just going by the rollover figures and some of the expectation of being a dark horse, I have 3 stocks on radar. First is Chambal Fertilizer. All these 3 stocks have held on very well in yesterday's fall also. So Chambal Fertilizer is a buy around 495 level for a target of 518 and a stop loss of 482. Next is from the banking sector, City Union Bank, a buy around 178 for a target of 190 and a stop loss of 173. And the dark horse that I'm talking about is NMDC. I believe that it may rally up to around 238, 242 in December series. It's trading around 227. One can go long in the stock with a stop loss of 222.
All right. Okay. Got it. Thank you very much for that, Avni. By the way, the pre-open has kicked off. Let's wait for it to settle because right now there's some red flashing on the screen. We'll see how it plays out. Right now, about 60 to 70 points lower on the Nifty in the pre-open session. Right. Let's, however, move on to a CNBC-TV18 exclusive. We told you earlier that Aster DM Healthcare is in advanced talks with Blackstone-owned care hospitals. Now we understand that a deal is imminent. Rachna has been tracking the story. She's joining in with the details. Rachna, so what's at play here?
Well, a deal is imminent between Aster DM Healthcare and Blackstone-owned care hospitals, marking a major consolidation in India's healthcare sector. CNBC-TV18 had exclusively reported in August that Aster DM was in talks to expand their hospital network through care hospitals. Blackstone, which owns about 72.5% stake in Care, and Mopin Family, holding about 42% in Aster DM Healthcare, will be doing a share swap agreement to finalize this transaction. The deal will create a new entity in turn with a leadership team comprising of executives from both Blackstone as well as the Mopin Family. And ownership stakes in the new entity will see Blackstone holding about 34%, TPG at 11%, and the Mopin Family about 23%. With each partner, that's Aster and Care, bringing in about 5,000 bed capacity to the table, this collaboration is poised to significantly enhance the scale and operations across India's healthcare landscape. And this will make the newly created entity second biggest hospital chain in the country. CNBC-TV18 has reached out to Aster DM Healthcare and Care Hospitals for an official response, but is yet to hear back.
Okay, well, deal imminent, and we'll tell you when it happens. Rachna, thank you very much for that. Remember, we'd reported this first in August of this year, and now, of course, we're putting it out there that perhaps a deal is very, very likely very, very soon. Let's put the focus on the insurance sector now. Now, stocks were under pressure yesterday. CNBC-TV18 via sources said yesterday that the insurance regulator, the IRDAI, is worried about insurers' dependence on bank assurance, banks basically, to sell insurance products. The dependence on bank assurance as a channel. And the IRDAI has also said that they will monitor the insurers' dependence on the bank assurance channel. And they've also advised insurers to reduce this dependence on bank assurance as a channel to sell these insurance products. Remember, you also, of course, had the finance minister making the same point. You also earlier had the IRDA chairman, both on record making the same point. We had some comments from some of the top insurance companies like HDFC Life, Max Life, SBI Life, post-close, essentially saying that they've not got any directive in this regard. But that wasn't our story. Our story, of course, was that in IRDAI, the regulator has advised these companies to reduce their dependence on bank assurance. Manas Agarwal is Vice President and Research Analyst at Bernstein, who's joining us now to take some questions. Manas, good morning. Great to have you with us here. Prashant this side. You wrote a note post that story as well, taking note of that story. Just your first thoughts, Manas. How do you read the situation?
Thanks for having me today. I think the proposal rumor or report that you guys put out, there was a counter proposal as well, and then companies have come out and made some clarifications. Very early days, but if this was to be implemented, this will be a major challenge for the private insurers on the life insurance side, simply because banca is around 60% plus of their total sales. So the first part of the proposal to control it to a lower than 50% number, that will be painful but possible. The other part is capping the share of the parent bank within total banca, which I think is more difficult to implement and which would be a bigger pain point if that is happening. Now, companies have said, and there are other reports also suggesting that this is not something that has been implemented or being proposed. So we'll have to see, but I think given the clarifications came in, I think stocks should open in the positive today, but I don't expect them to cover up all the losses from where they were at the point where the news broke out on CNBC.
Manas, so that is exactly the point. There are two things here, right? One is total dependence on banca. The second is, the dependence on respective parent banks and what happens there. So the story, I just want to clarify for our viewers, the story, of course, which we put out yesterday is the former, which is that, they've sort of asked and advised insurers to limit total dependence on bank assurance as a channel to under 50%. That is essentially the story. As far as they've also asked dependence on insurers to reduce dependence on their private parent banks, but there is no limit. That 50% is for bank assurance as a total channel. Do you think if it is the former which gets and there'll be a timeline, glide path, and there are other details which we put out, as you must have seen, the damage perhaps is going to be limited if it's just the former and done in a incremental way?
Yeah, if it's just the former, then the damage will be much smaller than it is proposed under the second alternative. There will be a long glide path that will be required. So today where people are at 60-65% banca, getting them down to less than 50 will basically mean they will need to invest in agency, which is a good thing in the long run, but near term there will be pain because you will ask your bank channel to stop growing to achieve this within a time frame, which whatever is proposed. So I think there will be pain either ways. The first proposal, lesser pain than the second proposal, more achievable as well, the first proposal than the second proposal. We'll have to see how this pans out. It's very clear, at least, that the government and the IRDA are thinking towards these things, the modalities of it, now with the pushback and probably the efforts by the companies to streamline these ideas. That will come out in due course, but there is some effort being made.
Okay. And that is, again, an important point that the finance minister and the IRDAI, as you said, it's coming from the top, right? The finance minister on record mentioned this recently as well. In terms of individual, you said, there are close to about 60% or so, the dependence on bank assurance, and then we should put that table up. We have the numbers for H1 of FY25. For players like SBI Life, over the last 1 year, they've already reduced. I don't know if you've tracked those numbers, dependence on bank assurance. And that kind of ties in with the fact that these nudges, this advice has been communicated to the industry over the last 6 months. So it's not sudden in that sense. Have you noticed that trend as well? Dependence on bank assurance, especially for players like SBI Life coming off.
Yeah, I think SBI Life was slower than the private sector bank dependence or sales in that channel. I think the comments you saw from the finance minister a few weeks back, probably they were given up to public sector banks earlier. And that started to reflect in SBI. That is one hypothesis. The company has not really commented or clarified on that aspect in their con calls. So we'll have to wait and watch. Irrespective, anyways, everyone was aggressively investing in agency. So agency channel has grown faster than bank channel for everyone. And that's a function of capacity addition over the last couple of years and in this year as well. So I think this is going to become a theme where agency becomes more important. Non-bank distribution channels like agency and Policy Bazaar stand to benefit. Players who have, for different reasons, already lower exposure to the bank channel, the parent bank channel, will stand to benefit. And that's broadly also going to open up space for players who don't have a bank backing. So there is a possible introduction of geo financials into the fray. So that all will level out the field to some extent for new entrants or foreign investors looking to start up under proposed 100% FDI. So that I think is the broad direction for the sector.
Manas, I'm looking at your current ratings, and you have outperformed on a lot of the stocks. You do like life insurance space, right? There's an outperform on SBI Life, on HDFC Life, Maxfin. You have an underperform on iPru and an outperform on Policy Bazaar as well. So now, going back to what you just said, that how it happens, what is the specific glide path, what are the specific levels, I think we'll get the answers in due course. But it seems to be clear, if you work with the intelligent assumption that in the coming weeks and months, the banca channel will have to be curved, right? And you'll probably have to build agency or some other format of pushing the policies or, the sales. Any back of the envelope calculations in terms of the cost, in terms of the additional capital needed? How should we start assessing the impact? Because this is coming from the finance minister herself, no less. So if we work with the intelligent assumption that there could be some pressure on the banca channel, what's the calculation we need to start looking at?
I think before answering your question, what we need to understand is 60% of private volumes come from the bank channel. So it's not going to be a hack and slash today. I think we are probably reading a lot into the pace of implementation. I think there will need to be a long glide path. Having said that, what this will mean is more agency additions. Agency does not entail a lot of capital, but what it does have is a longer gestation to get to a stable cost kind of a scenario. So that will be a drag if and when the companies decide to go down the path of investing in agency relative to banca. And that will need to happen. I think that will play out. In terms of the names that you mentioned, yes, the view will have to evolve. We'll see how details come out. One from the regulator, other is from the companies. I think players in the non-bank distribution model will stand to benefit if and when this gets implemented.
Absolutely. LIC, ICICI Pro, etc. Thank you very much for joining us, and good speaking with you here, Manas. Clear conversation and some insights as well. Now, microfinance companies have been under pressure. Goldman has downgraded their rating on credit access. Abhishek is here to tell us that. Abhishek, morning.
Morning, Prashant. So Goldman Sachs has downgraded Credit Access Grameen to sell from buy. They have cut the target price by 60% to 564 from 1,426 that was there earlier. They say that earnings visibility is clouded amidst asset quality concerns that is there, and derating structural in nature now for Cradac. So they have been negatively surprised by the acceleration seen in the decline in asset quality in Q2 of FY25. So they expect deterioration in asset quality to accelerate further, and also the impact from MFIN regulations will be felt in Cradac book. So they cut the EPS by 40 to 50% over the next two fiscals, that is FY25 to FY27. They expect credit costs to remain elevated over the next 2 years, and valuations don't adequately reflect the underlying stress in the book that is there. Back to you.
All right. Thanks very much, Abhishek, for that. Market open coming up, and you'll see the credit access stock also in a bit. But as always, we start with indices about 0.25% higher, 23,984. You got the Nifty Bank, which is up about 1/3% up, so 52,073. And mid-cap index, I saw some green, but now some red as well. It's kind of flattish at this point in time. 60 points on the Nifty. You've got the IT index, which is down about 1/3%. I can see that 2:1, but this is just too early for making any conclusions about the broader market. The Nifty heat map is telling you that you've got 38, 39 odd names in the green, and a minority of stocks which are starting up in the red. But it's about stocks. Surabhi.
And let's start with insurance right there. And there is recovery after yesterday's big drubbing on these stocks. HDFC Life, SBI Life are up about 2%, about 1.5%. Even the non-Nifty names, look at ICICI Pru, 1.5% up. Max is up about 1.5%. So even LIC, almost 2% higher. Recovery on life insurance, that's theme number 1. Let's come back to the Nifty and see what else is moving. Some of the gainers include Adani Enterprises, Sun Pharma, Adani Ports. So some of the Adani stocks are also recovering from the looks of it. There's buying on Lever, Reliance. Some of these heavyweights are doing well. HDFC Bank can be counted in that list as well. So these are some of the early movers. Titan, Tata Consumer. These are some of the consumer names that have started off positive. What isn't doing too well is technology. TCS, Tech Mahindra, HCL Tech, all those stocks are lower. Infosys is also down. And Power Grid is cooling off. So actually Nifty is quite okay. Barring tech, almost everything is either flat or positive. And life insurance stocks are definitely on the mend, at least for now.
All right, well, let's take a look at a few stocks. Easy Trip, that stock is up, in today's trading session. So big volumes on that one. Adani Green continues to chug along. That's up close to 9%. Z Enterprises, I think you've spotted that one out. That's up close to around 8% now. Honasa yesterday was up, I think, close to around 10-15% in the last couple of trading sessions. Honasa today as well is up close to around 7% or thereabouts. So big move is what we're seeing. In terms of top, volume movers, you also have Man Infra. Don't normally spot that stock, but it's one of the top volume gainers in today's trading session. Credit Access Grameen continues to move lower. That's down close to around 11%. You have Kochi Shipyard as well. That's seen some profit taking. Now down close to around 3%. And Bharat Dynamics, that one as well, on the losing end. So the headline index bounces back. It underperformed yesterday. Today it's doing a relative outperformance, up 60 points. While the mid-cap index, well, it's mildly in the red, but the breadth of the market, you have 3 stocks that are advancing for 1 stock that's declining in today's trading session. Looking at the top movers as well, let's pull up a few stocks that are eligible for the F&O trading from today itself. Geo Financial, I think that stock had opened up with a green tick, so that's up close to around 1% or thereabouts. Zomato should come up for you in the screen. That is making fresh 52-week highs, as well as Swiggy. Yesterday, I think Swiggy as well did quite well. Zomato for the time being mildly flattish to a bit of a negative bias, while Swiggy as well, I think yesterday it went all the way to around 520, and from there it's pulled back a little bit. But a good start. Let's hope that the bulls can build on to this. NCC, that one is moving higher on very, very large volumes. And I was looking at granules as well. It appeared there is some long addition on that stock. So keep an eye out on that stock for the next few trading sessions. December could be a crucial month for this one. Granules should come up for you on the screen as well.
Yeah, NCC moving because of this large order win that they've announced, over 3,000 crores, this Ken Betwa link. By the way, Honasa, look at it. I mean, the fall was dramatic and the recovery seems to be equally dramatic. Yesterday, 10%. Today, you've got 7% on Honasa. This week's winnings for Honasa already 20%. So pretty dramatic moves over there. And Sagility is the recent listing, has put on 28% this week. And Friday's only just begun. 3% on Sagility as well. The Adani group of stocks, like Nigel mentioned, all the gains are pretty much intact. I mean, Adani Power, Green, Total Gas, all of these stocks are up and about as we look at them. Let's just check some of the PSUs. Yesterday, the PSUs managed to buck the otherwise weak market trend. This morning, let's pull up NMDC and the likes. NBCC and Hutco. These were the stocks that announced order wins yesterday. They were up and about. Union Bank is up about 2%. IOB, so some of the PSU banks are still carrying on, but the other stocks, Hutco, IRFC, RVNL, NBCC, they've come in for a bit of profit taking.
Credit Access, right? That is the one which is selling off hard, and it's a big knock. It had come up a little bit from the lows recently, but guess what? All of that basically it recovered 10% from the lows. And it's giving back those the 10% once again. So we're pretty much, I think, in the lows of the cycle so far as this one is concerned. The thing is, Credit Access is widely considered as the best in the industry. I mean, it's like the highest quality microfinance name. And if Goldman's view is this with Credit Access, I mean, I'm also wondering what the view is. If they have coverage on other microfinance companies, what the view is there. We'll see if this comes to fruition in terms of their view and whether there is more pressure. Well, I think we rushed Abhishek through into market open. He was getting us that view from Goldman Sachs. Abhishek, you left off saying 40-50% cuts to their earnings estimates for the next 2 financial years. I mean, that's steep.
That's very steep, and the stress in the MFI sector that we highlighted to our viewers in May of 24 has panned out over the 2 quarters, that is Q1 and Q2, and now we are seeing brokerages downgrade stock price as well as recommendation on lenders with MFI exposure. So Goldman Sachs is the first one, and this is one of the biggest downgrade that you are seeing in the MFI lending space. On Credit Access Grameen, they have downgraded to sell from buy, cut the target price by as much as 60% to 564 from 1,426 that it was earlier. And they say that earnings visibility is clouded given the fact that asset quality hiccups are seeing, and there are concerns with respect to asset quality in the near future as well. De-rating structural is in nature right now, and they expect further de-rating of Credit Access Grameen. They have been, the deterioration in asset quality, which they expect it will accelerate further, given the fact that there are new guardrails which have been put by MFIN. So MFIN has actually reduced the number of lenders to a single borrower to be at 3 from 4 that they had earlier. So they have cut the EPS by 40 to 50% over the next few fiscal, that is FY25, 26 and FY27 as well. They expect credit costs to remain elevated at 6.5% or 6.6% to be precise for FY25 and about 4.5% for FY26. So valuations as per them don't adequately reflect the underlying stress that is there in the sector as well as the book. Also, they have written on financials, that is Goldman Sachs has written, they say that sizing the microfinance stress could be as high as $4 billion to $18 billion, which is like almost 1.5 lakh crore of stress that they anticipate in the microfinance segment, which is potentially on the higher side if you take a look. So they have a sell rating on Credit Access Grameen. They say that you should or one investor can buy AU Small Finance Bank, L&T Finance and IndusInd Bank as diversified players are better placed than only microfinance lenders. Back to you.
All right, Abhishek, thank you very much for that. So that's a more detailed kind of explanation of what Goldman is saying. Credit Access, by the way, from the opening lows, it's up about 4% or so. But this is still very, very early days. It's a still big 7.5% cut that you have on your hands. The other thing, of course, is that if you look at microfinance lenders across the board, Credit Access maybe has the lowest rate of lending. So, that's the other thing to consider. And it takes me back to the earlier point that what about the others? I mean, only MFI players. What happens to them if this is the state, as Goldman puts it, for Credit Access. Devina Mehra is our market master of the day, founder, chairperson and managing director at First Global. Devina, great to have you with us here. Thank you very much for your time. Prashant this side. I don't want to talk about microfinance and what stocks, etc. will do, but just use that as an example to ask you whether it does show stress in the system, the consumer stress at the lower end. And how would you read it? What are the implications, not just for MFIs per se, but for the broader ecosystem?
Good morning, Prashant. So you talked about the stress at the kind of bottom end of the market, and that is something which most people have discovered only after the market corrected. But this is something I have been speaking about for many quarters, that there has been a consumption slowdown, and that's not happened just in the last quarter. If you look at the last financial year, 23-24, and you look at just the consumption number out of the GDP, that was the lowest it has been in 21 years. So, that was very much visible. Your GDP was essentially running on the single engine of government expenditure. If you look little broader term, there's this book called Lilliput Land by Rama Bijapurkar, and that showed how for the bottom 60% of the Indians, their real income has fallen from 2016 onwards. That for them, the income minus even routine expenditure, I'm not even talking medical or marriage or anything, is already negative. So if you parse it out into what you see in corporates, once again, if you see entry-level cars, the numbers have actually been dropping. So people have not been going up the income ladder. I sometimes see some talking heads on your TV or your channel, a few months ago saying, oh, all of my friends are buying luxury homes. They're all buying luxury SUVs. The economy is booming. But people like us are not the only people who are there in the economy. So yes, there's stress. If you talk of credit in particular, I was a speaker at this business summit, and one of the things which was like a light bulb moment for me was when Mr. Kamath said, I mean, these two stresses I had talked about separately, I had not put it together, that you think about all the losses in the F&O markets, and those are mostly made by individuals. So I think the figure is something like 1.5 lakh crores or something like that. And Mr. Kamath said, just think about how they have been financed, and almost all of them would have been financed through unsecured credit of this kind. So that's another, direct market related point that goes into credit. And many of the fintechs and all the smaller players have been going down the credit score. The credit score at which banks wouldn't lend is where these guys come in. So there are many stresses in the economy, but they have been there, as I said, for a while.
The thing is that I think the RBI has been quick to tell a lot of the lenders to go a little easy on things like unsecured, etc. Right? They raised the alarm bells a good year in advance almost. I remember when the risk weights went up. So hopefully, I mean, I guess that's the hope, Devina, that this is not going to spill over beyond microfinance. Actually, let me ask you that first. Do you think this will be contained? And what are you doing in financials? And let me throw in the whole insurance question as well. We spend the better part of the morning on that debate as well, because it seems that this banca channel, in some format or the other, there will be some regulation on how much of insurance sales can be pushed through banks. So tell us more about financials, both on MFI, stress, whether you think it will be contained or not, and a word on insurance.
So banks, we are underweight as usual. I would say the only time we were market weight to slightly overweight was 2022, which was the only year in the last 5 years that the bank Nifty has outperformed the Nifty. I mean, right now, if you just look at pure technically, the banks might do actually a bit better. That's that. But these medium to long-term concerns are what give me sleepless nights if I was invested a lot in that sector. As I always say, the problem with the banks and all lenders is that you only get negative surprises. It is not as if the borrowers do very well, they will get some supernormal profits. But if there is a problem, there is a hit. So that is the concern always with banks and lenders. So that's why as somebody was saying that you repeated in every interview of yours that I'm a nervous investor in banks and lenders. Very few times that you are comfortable being there. And a banker was recently telling me, I have not studied that myself, that gold loans have been going up. And he says that's another source of, indicator of stress in the system, because the jewelry is kind of the last thing people mortgage to get money. So those are things. Insurance, yes, there have been a lot of now changes being announced. We are still studying it. It's not a sector we have a big exposure to, so we didn't need to react immediately. Got your point. They've been beyond the banks, and you've articulated the concerns over there. Financials elsewhere, and we're saying insurance, you don't have an exposure. But capital markets has been doing really well. People seem to be really gung-ho on the wealth management business as well. Just trying to get the overall picture on financials, even the non-lenders, if there's anything that you've bought in this recent correction or anything that you like. We haven't bought much. We used to hold a number of capital market related stocks earlier. So the stock exchanges and players in the market and AMCs for that matter. But in our July rebalance, our system stopped liking them. I mean, or rather you can say that liked other things much better. So we actually exited most of them a few months ago.
Hi, Devina. Good morning and good to see you. And let's talk about the consumption theme then. Staples as well as discretionary. You have some allocation, I think 13 to 14% of the total portfolio. Could you tell us, as of now, where is the preference?
So I'll tell you overall which sectors, because this is a very broad level classifications. For example, autos go into consumption and so on. So let me tell you where, in terms of the sectors that you and I understand, where we are overweight. So we would be overweight pharma and healthcare, that would be probably a biggest overweight in terms of just the percentages beyond where the benchmark is. IT, we would be overweight now. Auto components, we continue to be overweight. Where we have added, I'm not sure whether we are overweight or not, in the last couple of rebalances has been chemicals, which after 2022, we were basically mostly out of, and then our systems have started liking them again. And of course, chemicals is a very broad sector, so the winners, the losers, depending on where in the chain you are, but that's one sector where we would have added. FMCG also we have added some. I mean, we had a very low allocation and we've added in the last two rebalances. But not so much of the very large companies.
Yeah, got that. Devina, the other thing, of course, which you track closely is global markets and global macro, etc. Now, Mr. Trump has put together his economic team. They all seem like they all dislike China. No particular views about India in that sense, which is I guess silver lining and good news. So they all train their guns on China. But you know, for the market here, is it going to be a little tricky? It's a minority view that, but you know, as I remember Christopher Wood of Jefferies saying that Mr. Trump is inherently he's transactional, and of course he's unpredictable. So we don't know how much of a how should one view this from an overall perspective as we head into 25.
So I wrote a whole article yesterday on this, on that only thing you can say for sure with the Trump Sarkar coming in is that uncertainty has gone up because a number of things he said during the election campaign are inherently contradictory. So, for example, he said that the U.S., the average worker the income has not kept pace with the inflation and there's been loss of purchasing power. Now, if you put a 60% tariff on China, you put tariffs on everything from Mexico and Canada as well. So for good measure, he said that as well. So that means everything on the supermarket shelves, the prices go out through the roof and inflation goes through the roof. So, I mean, you are not even sure. I mean, that's only one contradiction. Defense stocks, for example, went up with his re-election, but he has also said that why should US spend on these overseas wars? So there have been so many things which are at loggerheads with each other. For example, if you really cut government expenditure drastically, government expenditure is 36-37% of US GDP. So that would be deeply recessionary. He says the US dollar should not be so strong in order for exports to be helped, but a lot of measures he's talking about would actually strengthen the US dollar. And to add uncertainty to the mix, his main advisor is Elon Musk. So if you wanted to compound uncertainty, you have a dream team there. So very difficult to predict even what he will do. Then what he does has an implication on inflation, on what Fed does, on interest rates, and the third order effect is on markets. The fourth order effect is on international markets. Then you have geopolitics, where you don't know what he will do, how the other players would respond. So they're like just infinite combinations if you go into game theory as to what would happen. But I don't think there's a lot of direct things which will impact India. I doubt it, unless he does something which impacts IT services or something, so that may be the only possible risk area which directly impacts India. So the rest of it, we'll have to wait and watch at least what he does before one can predict what will happen. Inflation already is little bit higher in the last print that came 2 days ago. So, that leaves again little less headroom for Fed to cut rates.
Sure. Yeah, I think we'll just have to wait and see. Direct impact could be whether we have Teslas on the road here in India, as well as Starlink, whether Mr. Musk manages to use his good friend's influence to open some doors here in India. I think we're in for interesting times on that one as well. Devina, always a pleasure having you on the show. Thank you very much for joining in, and we look forward to the next call. You have a great weekend, and thank you for joining us this morning. Okay, quick check on the market before we move to our next guest. The market's actually galloping along quite nice and steady. 100 points up on the Nifty, and 24,000 is back on the screen. So there's a nice large cap recovery that's in the works. Okay, we're putting the spotlight on the banking space, in specific, Union Bank now. The second quarter was a slightly weak quarter for the bank. Loan growth has been weak if you compare it to peers. And obviously, the fight for deposits remains a big talking point for banks across the board. So how is the second half likely to shape up? We have with us Mr. Srinivasan Vardarajan, non-executive chairman at Union Bank of India. Sir, great to have you. Thank you very much for joining in. You know, before we talk about growth, I want to sort of start with the whole asset quality question, because not just for you, and you also saw a big rise in slippages. Your slippages in the second quarter were above 5,000. That was, I think, they almost doubled, more than doubled. But this is a larger question, right? We're looking at some Goldman Sachs notes right now. They're trying to estimate how big the MFI stress pool could be, and it's running into billions of dollars, those estimates. So first, you tell us whether is there any threat at all of a spillover of the MFI stress into other parts, or maybe not, because anyway, you know, MFI is very niche, and banks are anyway not lending to those kind of customers. And B, even without MFI, is there more stress building up? What are the trends that you're seeing in the third quarter, given the rise in slippages that you saw in the second quarter?
Good morning. Thanks for having me on your show. See, I think as far as asset quality is concerned, I think the central bank has been very proactive in terms of trying to guide the banks, as well as do some macro-prudential measures to ensure that the right actions are taken by all stakeholders. So banks, if you look at the products which to some extent stress was building up, I think those products have broadly slowed down, and you can see that over the last 2-3 quarters. So I would believe that, yeah, the asset quality thing, I think we hit a trough in terms of what exactly slippages would be for the system as a whole about in the last financial year. From there, it'll tick up, but the ticking up is not going to be something which is going to be anything large, and it's going to be anything systemic. On the whole, I think it'll be something which banks will be able to absorb and move on.
So can you quantify that? Maybe not for a system as a whole, which is a larger, bigger guess, but at least for Union Bank. When you say that overall stress will tick up, to what extent? I mean, what is the kind of GNPA movement that you're factoring in by the end of the year and next year as well?
I think it will be broadly around the same levels which you've seen over the last 2 quarters.
Which means gross NPAs would
if you look at the last quarter, I think so some of the slippages were driven by some large asset slippages, single accounts in terms of large corporate. And I think if you look at outside of that, the slippages are fairly well contained. And I think that's how you look at it in terms of segments which you're talking of, which is basically small ticket lending.
Okay, so would that mean that your gross NPA levels would be contained at around 4.4% thereabouts for the end of the year?
Yeah, I think, yeah, it'll be around the same levels where we've seen.
Okay.
All right.
I think one thing you should understand is, I think,
Please go ahead, sir. Please go ahead, sir. Complete that point, please.
No, I'm just saying that the broad level of slippages as well as asset quality ratios would not be very different from what you've seen over the last couple of quarters.
Got it. All right. Hi, Mr. Vardarajan. Good morning and good to see you in. This is Nigel on this side. I'm looking at your advances as well as deposits. You know, out there, the growth has been slower than what we're seeing in the industry, which could, the read-through could be that you're losing market share. Could you tell us if this is strategic in nature? And what is the outlook on both these two fronts for this fiscal and the next?
Now, if you look at what's happening for the system as a whole, clearly deposit growth has been lackluster and has been lagging credit growth for the last many quarters. And that wedge is sort of right now contracting. And I think that is coming on the back of credit growth coming down. Credit demand has been reasonably low, and it's important to make sure that you do credit where it is remunerative for the bank. And then to that extent, I think the bank has been judicious in terms of what sort of credit it undertakes. And the resultant thing is that deposit growth has been marginally lower than what the system is, because credit growth pickup has been fairly muted for the system as a whole.
So what's the outlook? I mean, I guess this is also a function of banks trying to shore up deposits, also focusing on asset quality, which is why credit growth has come off a little bit. But if you could just elaborate, I mean, for Union Bank, how do you think you'll end the year? Last quarter, year on year, you were up about 10%. So how will you end the year on credit growth?
broadly in the range of 10 to 12%, 10 to 11% range. I think that's the idea. But broadly, what you should look at, I think I'd like to stick to what the system would do over the next couple of quarters, is that if you look at the one thing which has not bothered the market is currency, and that is what is top of mind today. And whether it is the dollar index or whether it's what's happening in terms of the rupee. So clearly, from a point of view of liquidity and in terms of how exactly currency moves are going to be there, I think that's going to be broadly driving deposit growth. And liquidity, in my view, rate cuts as of now keep getting postponed. Liquidity continues to remain fairly tight. So therefore, to that extent, I think deposit growth is going to be not galloping away. It's not going to be much higher than where we are today, with the result that credit growth will be where we see it here or slightly marginally lower for the system as a whole.
10 to 11%. Before we wind up, Mr. Varadarajan, wanted your view on the NIMS outlook. It came in at a multi-quarter low in the past quarter. So what's the range we should work with from here on? If you want to give us a guidance on the return ratios that you can achieve in the coming year.
I think the management was on air post the last quarter results, and I think I would just like you to refer to the guidance given by them, and I think that's broadly, as I said, around current levels.
Srini, hi, morning. Prashant here. I don't know if you heard Devina Mehra, who was with us from First Global earlier before you, and she was quoting Mr. K.V. Kamath and what he said at a recent event. And this is a broader industry question, not about Union Bank. She said Mr. Kamath essentially said that a lot of the, and this is his thinking, I mean, he was I think, throwing that thought out. He was saying that maybe a lot of the capital market losses, especially on the F&O side, over the last couple of years, perhaps could be being funded by unsecured loans. I don't know if you have any thoughts at a general level.
I think that's been a concern in terms of end user funds, and that's why RBI sort of acted in terms of putting in place some microprudential measures. And I would think some of those losses have not happened on a single day. It's been happening day on day over the last couple of years, and therefore whatever things need to happen in terms of the asset quality, I think is already taken place. And incrementally, I think the amount of exposure which people are taking in F&O is going to come down on the back of SEBI's measures on F&O. And therefore, I don't think this is a problem which has grown larger day on day. I think the problems whichever have happened, I think have been taken in by the banks and NBFCs. And I don't think so this is something which will linger on going forward. The problem is in terms of some of these end users on consumption, which broadly, where the cash flows of borrowers match the liabilities which they have to undertake. And I think that's the broader question. I think the capital market thing for banks is a much smaller question in my view.
All right, we leave it there. Thank you very much for joining us, and it's a pleasure. Have a good conference at Trust. Thank you indeed for being here on CNBC TV18. We'll take a quick commercial break here. Saurabh Gupta of Dixon Technologies will be joining in. It's one stock which has done phenomenally well. Motilal Oswal recently came out with another sort of report, buy rating, suggesting further upsides. That conversation comes up. Welcome back. 100-point triple-digit gains on the Nifty. So it'll be a nice way to wrap up the week. 24,000 plus is where the Nifty finally is ending at. In the first hour, the end of the first hour, not the end of the... It's a Friday, Surabhi.
Yeah. Counting down. The countdown is on.
The countdown is early in the countdown, let me put it that way. The Adani Group stocks, by the way, are doing well. Power, Green, Adani Total, Adani Energy Solutions, so this is the third day of recovery and repair that we're seeing out there on this particular space. Honasa is the other one. Honasa is up 6.5. Again, completely got smashed up, ended about 10% higher. Yesterday was the first day of recovery. It's up another 6.5. So just some additional names which were not there in the mix at 9:15. Well, let's talk about the EMS space, and the leader there, of course, is Dixon Technologies. Motilal is bullish on the stock. It's been a huge outperformer. And there is more coming if you go by Motilal. Saurabh Gupta is Chief Financial Officer at Dixon Technologies. Saurabh, it's always great to see you. Thank you very much. Good morning. Prashant this side. You know, it's always whenever we chat, Saurabh, what's the latest and what's the new thing at Dixon, which I want to know, because you guys are always tying up, bringing in new partners. I believe there is work going on sort of getting a couple of more Android players to partner with you. Those talks are on. So tell us, what's incremental, what's new, and in terms of meaningful stuff.
Yeah, so clearly, Prashant, the mobile is the largest addressable opportunity. And within a short span of last 2 years, we have been able to get almost all the brands on the Android ecosystem. Some more brands are in discussion, and hopefully we should be able to conclude with them in the next couple of quarters. Apart from that, the focus in mobiles is also on the backward integration, deepening the level of manufacturing. So there is a component PLI which is expected hopefully before the end of this financial year. And we as a company, we think we'll make significant investments in displays where we've already tied up with HKC. We'll be looking at doing investments on precision components, mechanicals, die cuts. So there we are pursuing partnerships. So we think we have an opportunity to take the value addition in mobiles from 17-18% today to almost 35-36% in the next 24 to 36 months. And we'll be making significant investments. So that adds to our strength, moat, and also reduces the cost of manufacturing in India, which makes us more export competitive as well. Apart from that, IT, I think, so is the next trigger for our growth.
Saurabh, sorry, we'll just come to IT in a bit, and that should improve margins meaningfully as well, wouldn't it?
Yeah.
On the component side, taking the share from 17 to 35%.
Yeah, significantly. We think it will start reflecting from Q2 of next financial year because that's where we start manufacturing displays. And then over the next 24 to 28 months, I think, so the margin profile, which is presently around 3.3%, can increase by 120 bips over the next 28 months.
Okay, so, and these precision elements, components that you're speaking of, this would include things like camera modules, because I think in our earlier conversations, we've kind of picked up that interest in getting into camera modules. So all of these kind of components will lead to this margin expansion, right?
That's right. So camera modules, mechanicals, precision components, and die cuts. So these are the 4 things that we are working on.
So just to understand, mobiles continues to be the largest segment for the company. Just give us a targeted mix, because then there's sort of IT components also picking up. Say FY26 end, what is the contribution that you'll still get from mobiles? How is the sales mix going to change as some of the other segments also kick in?
So my sense is it will still continue to be around 60 to 70% of our revenues, anywhere between 60 to 65, because clearly we have a strong order book also in our telecom business and also in IT hardware business. So definitely I see some percentage contribution of mobiles coming down from 70% to broadly 60-65% as the other 2 verticals also start firing.
Okay, so let's actually talk about some of those other verticals. IT hardware. So where are the plans right now, and when do you fully come to market? What are the timelines that you're working with? And I think a lot of tie-ups have already happened with some of the major hardware companies. Any more in the pipeline?
Yeah, so I think so. We have already acquired 4 large customers, which is HP, Asus, Lenovo, and Acer. For most of them, we will start manufacturing by Q4 or Q1 of next financial year. We're also pursuing partnerships on servers. So servers can be a very large opportunity for India, and we are pursuing some kind of partnerships. Hopefully, we should be able to announce something in the next couple of quarters. So IT hardware looks very promising for next financial year. And we think the overall addressable opportunity at a manufacturing level is almost $8 billion, almost 60,000 crores. And like the way we acquire a large share in each of the categories, similarly, we feel that over the next 2-3 years, we should have a large play in this category as well.
Okay, all right. Hi, Saurav. Good morning and good to see you. Well, display manufacturing, what's the kind of volume we can look at? I think in FY26, we'll be guiding for something like 20 million, which goes much higher in FY27. If you could help us out with a couple of numbers, display manufacturing.
Yeah, Nigel, so in the first phase, you're putting up a capacity of 25 million mobile displays and almost 12 million IT hardware displays. IT hardware displays already part of the PLI scheme for IT hardware. And in the next phase, we'll take this 25 million to 45 million displays because we already have a large customer base on the Android ecosystem. So yeah, next year, broadly, it will start from Q2. So the first year, anywhere, we are hopeful that we should be doing somewhere around 14 to 18 million kind of displays. And then year on year, those numbers will increase because clearly there's a big business case. There's a big duty arbitrage on importing a display, so versus Indian manufacturing. And also, clearly, the component PLI will further add to the overall advantage in that.
All right, so 14 to 18 million for next year, right?
That should be the broad numbers, yeah.
And since your capacity is going to go from 25 to 45, the following year we should work with a number of 30-35 million at least?
Broadly, it has the potential to double from those levels, yeah.
Okay.
Saurabh, just a couple of more questions. Just to, as we come closer and come to the fag end of the, not fag end, but yeah, I mean, the last month of the third quarter, you'll have better visibility of FY25 numbers overall. Closer to between 35 and 40,000 crores in revenues this year?
I think so. That should be doable, Prashant. We have done, I think so, broadly 18,600 crores in the first half. Definitely, I feel the second half should be better than the first half because the Q1 was slightly slower for us. A lot of customer ramp up happened during Q2. So yeah, I think so. The H2 should be better than H1.
Okay. One more thing from my side. You know, this entire we talk about Make in India, but now there is Make in America. Make America Great, right? That is going to be the talking point, etc., over the next couple of years with Mr. Trump. You know, one view is that he's going to use tariffs as a threat to essentially force companies to make in the US. As the largest EMS player in the country, Saurabh, do you think it's viable to make in the US? I mean, shift what is happening in countries like India, China, Vietnam, etc. I mean, to move supply chains onshore in the US. Do you think it's just too expensive and it's all just rhetoric?
I absolutely feel the same way, Prashant. And US can be a consumption economy, but as far as manufacturing is concerned, the cost of manufacturing in US is very high. So my sense is there can be shift in supply chains in the Asian countries. I think so. India can be a big beneficiary. Clearly, I see that tariffs, if they are put, the increase in tariffs on a neighboring country will be far higher. And I think so India is well positioned because of the advantages that India enjoys on a large labor pool, low labor costs, strong government policy framework, companies like us having a scale and size. So clearly, I think so India, should gain out of this overall thing. But yeah, one has to wait and watch. But definitely, I feel that manufacturing in US is that tough, I would say. It's not so easy.
Got it. All right, Saurabh, you know, you've helped us out with the business aspects. Just one factor I wanted to ask you. The promoter entity, they had around 34.5% stake in the company. And as of the September quarter, that's come down to a little south of 33%, to be precise, 32.89%. So very, very small selling is what we're seeing out there. Could you clarify about what's the outlook from here on? Because in the last year and a half or so, it's down by close to around, 1.5%.
So Nigel, it's a small selling. It's basically he's a first generation entrepreneur. I think so. He wants some liquidity for his personal needs, but I don't see he's completely invested in the company, and we clearly have a long way to go. So yeah, this is just a small selling. I don't anticipate any further selling broadly from this.
All right, thanks for that clarity, Saurabh, and do communicate to Mr. Lal and the family. I believe there's a family wedding, one of his children. So best wishes from all of us here on CNBC-TV18, and all the best to the entire Lal family.
Thank you, Nigel. Thank you, Prashant. Thank you, Sukhbir. Thank you.
Thanks a lot for joining in. Well, let's take stock of the market yet again. Sukhbir?
Okay, well, things are looking up, looking good, 128 points higher on the Nifty. And if we talk about some of the key movers and shakers, so there is a Cipla, which is the biggest gainer right now, 2% higher. Actually, even Dr. Reddy, some of the pharma names are doing well. And a couple of the biggies, HUL, L&T, these stocks are fired up, even Reliance for that matter. So it's sort of all hands on deck today.
Just one stock, Surbhi, Mazagon doc, when we started, we were talking about one of the stocks that were lower. That stock has done a complete U-turn. It's now at the high point of the day, up close to around 3%. So a few of these names have done quite well. PP Fintech as well, that's the other one. And Edelweiss Financial these are some of the stocks that have moved up quite well from the low point of the day. So just trying to focus.
There's one more name is LIC. LIC is up 5%.
Because they don't
No
have any
banker.
So, and guess which were the other name yesterday, which was higher? Well, all insurance names were lower. ICICI Pru. ICICI Pru does not use ICICI Bank as a bank assurance partner, the parent. ICICI Pru is kind of flattish, but yesterday it ended higher. I think it was down substantially. LIC is up about 4.5%. So 780 coming through there. So there is a lot happening, and we'll continue to track individual names. Mitesh is with us with what he's making of the sort of trade and the setup so far. Mitesh, early days, or you trust this 100-point up move and bet on more? What would you do?
Prashant, not much, honestly. I think, as I said, 24, 120, 24, 150 is the zone. So we might actually see some more points added on the upside, but till we cross and capture those levels, I would not be trading long on the index. On a stock-specific basis, yes, we have identified some trades which are looking good. Bata is something, which did not fall much in the decline yesterday and has bounced back immediately. And the structure is also improved dramatically here. So keep a stop at 1360. Look for a target of around 1410, 1420 on the upside. And the other stock which I like is Crompton, which can be bought with a stop below 400 for targets of 400.
Okay, all right, got it. Amitesh, thank you very much for that. So those are some of the calls coming through. Let's just go back to Credit Access and see what the stock is doing. It's still down about 7.5%. And this is after, of course, Credit Access having lost a lot of ground in the last couple of months. That's today's decline. Let's pull up a one-year chart as well on Credit Access. Stock's down about 40-odd% this year. A lot of, there you go. So big decline through the year, but then this fresh sort of messaging that's come in from Goldman Sachs, that's leading to another round of selling today. Abhishek is joining in, and he's been flagging off the stress in the MFI space for several months now. So Abhishek, what's the latest on MFIs and of course on Credit Access?
Goldman Sachs has written on Credit Access, Grameen. They have downgraded the stock to sell from buy. Target price has been cut as much as by 60% to 564 from 1,426 that they had earlier. They say that earnings visibility has clouded given the fact that there is asset quality worries that they see for the entity going ahead. And derating is structural in nature for Credit Access, Grameen, from here onwards. So they have been negatively surprised by deterioration in asset quality in Q2 FY25. They expect a deterioration in asset quality to accelerate further given the fact that MFIN has come out with new set of guidelines wherein you have to reduce the number of borrowers, the number of lenders to a single borrower to 3 from 4 that they had earlier. This can mean slowdown in growth as well. So they have cut the EPS estimate by 40 to 50% over the next few fiscals, that is FY25, 26 as well as 27. They expect credit costs to remain elevated at 6.6% for FY25 and about 4.5% for FY27. So they say that valuations don't adequately reflect the underlying stress that is there in the portfolio. Now, Goldman Sachs has also written on financials. They say that the microfinance stress that could be as much as $4 billion to about $18 billion. That's a huge number that they have put in with respect to stress in the MFI portfolio in India. So they have a sell on Credit Access, Grameen, while they say that diversified players look better placed right now, like AU Small Finance Bank, L&T Finance, as well as IndusInd Bank. Back to you.
All right, Abhishek, thank you very much for that. So those are some of the names up on your screen as well, with that Goldman call coming in on MFIs and the downgrade on Credit Access. Z is the other one we want to focus on. Stock is higher. Vamakshi is here to tell us why. Vamakshi, morning.
Well, good morning, Prashant. Well, Z is definitely trading higher in the trading session today. Keep in mind that, the shareholders rejected proposal to reappoint Puneet Goenka as the director of the company at its AGM on November 28th. Now, this proposal was defeated by a 50.4% vote against this. In fact, earlier on, proxy advisors like InGovern and IIAS both had recommended shareholders to vote against his reappointment. And in fact, largely, when we look at the overall picture, nothing much changes for Puneet Goenka because he had earlier on November 18th as well stepped down from his position as the MD of the company and had said that he would like to concentrate on operational responsibilities as the CEO of the company, and therefore that still continues for him. So that is the news flow around Z. The stock as of now is up in trade.
All right, Amakshi, thank you very much for that. So it's Z about 5.5% higher. Well, we'll take a quick commercial break here. Manisha Gupta is going to be with us, and we put the focus on commodities on the other side. Stay tuned.
Welcome back. Okay, so the equity market's holding up quite nice and steady. Let's figure out what's the latest in the commodity markets. We have Manisha joining in. Manisha, so what are you tracking right now?
Well, I'm looking at metals as a sector because more metals than other seem to be heading for a strong week on this one. One, you've seen a bit of a pullback in US dollar index, and that has been supportive. The other thing really is about the rising cost at mines, underinvestments, declining inventories. All of that has been supporting metals as well. And the street is awaiting details on the US plans on tariffs. I mean, that detail would come in the first quarter of 2025. That is when you will see the markets settle down a bit. But until then, it continues to be volatile and slightly on the higher side as well. Also, there are yet again expectations that China could be coming out with some major stimulus before this year ends, and that has been keeping markets or other metals in happy favor there. I want to start with zinc because we're trading at a 4-week highs onto this one. Zinc seems to be outperforming many of these metals. One, the latest news coming in from Trafigura Group, which has ordered big withdrawals from LME. When you look at the last couple of days itself, the kind of withdrawals that we've seen in sense of LME are the highest in a decade, more than 97,000 tons. If this gets out of LME, then the kind of remainder inventories that we are looking at on LME are much on the lower side at just about 154,000 there. So this will keep the zinc prices under support. Other is aluminum, where we have seen prices continue to gain up. We did see 5-month highs in the early part of this week itself, while the prices have come off those kind of numbers, but the kind of fundamentals we are dealing with are still on the supportive side. Russia's Rusal is going to slash 6% of output. You have alumina costs, which have doubled to $700 a ton, and then alumina supply disruptions from major producers like Guyana, Brazil and Australia will continue to support prices. You have lead as well, which is trading at a 5-week high, so more metals are actually trading at multi-week highs. I want to take you through a table which shows you on what we've done in sense of metals in last 1 week and in this year until now. So on a week-on-week basis, the best of gains coming in from zinc. We've told you on what really has led that rally. Aluminum has seen a 1% decline, but on an annual basis, we are 9.5% on the higher side. So two metals which have done the best really are aluminum and zinc. Copper from the higher side has seen a decline, and we've seen the net longs kind of continue to decline last couple of weeks. So that is what is putting pressure on the prices. But overall, yet another year where we would be closing it in the positive for many of these metals.
All right, Manisha, thank you very much for that. So that is commodities in focus there. Well, FMCG major HUL has outlined its growth and category targets as part of its Capital Markets Day. Mangalam is here with highlights. Mangalam, morning.
Morning. So the meet starts at 11:30. The company has uploaded its 270-slide presentation on the exchanges already. And these are, important ones to look at, not just for HUL, but the entire consumer sector itself. And what's promised actually happens, then it's a crazy look into what HUL 2.0 for this decade looks like. The key highlights, 2 to 4 times potential is what they see in terms of increase across categories. What has happened over the last 3 years is there has been a 200 basis points market share gain with nearly 1.3x jump in revenue as well as profitability. They also see about 100 basis points savings through efficiencies, and they've identified a bunch of brands, the likes of Surf Excel, Vim, Dove, Pond's, etc., at the sweet spot of premiumization. They are seeding a lot of premiumization in the beauty and wellness category, as well as food and refreshments. They've also spoken about 6 long-term opportunities, which is 1 in premium face care, premium healthcare, body wash, home care, condiments, as well as prestige and well-being. What's interesting, and this media analysts would be, very importantly tracking, their share of advertising on TV is actually down from 60% earlier to now 39%. A large part of their advertising goes on social media, so we'll keep an eye out on that one. They've onboarded 1.4 million retailers, and 50% of their revenue share is now generated from their Shikhar app itself. And to my mind, the most important development that the company has announced is that they've announced winning in many India's 2.0. Remember, WIMI 1.0, when it was first announced in 2014, was a transformative exercise to classify India into 16 socio-economic clusters. Now they've gone ahead and further classified these clusters into affluent agglomerations as well. So earlier you were talking about 16 spots in India. Now you are also talking about that affluent market, which a lot of people are ceding share to a lot of these new digital brands as well. So if HUL goes ahead and does that over the next few years, we can see accelerated growth. The strategy is laid out. The important part is executing them.
Okay, all right, Mangalam, got it. Thanks very much. So that is the takeaway from the analyst day at HUL. Markets holding up 100 points higher. If you look at some of the stocks on the move, the insurers are still trying to recover most of the ground, but it's turning out to be a good day for pharma, by the way. Even Sun Pharma has now joined the bandwagon. So Reddy's, Cipla was always the nifty gainer. And then there is Sun Pharma that's rising to the top now. That's pretty much how it is. But Prashant, you were looking at credit access once again?
No, I was just saying that, if you measure the total movement, it is up more than it is down. It is about 7%. Sorry,
what?
Basically, it's recovered 7% from the day's low.
Okay.
And now it's only
down. So up more than down. Okay.
That's a new one, right? But 50 points lower on 50 rupees lower on credit access, and it's come up very nicely. Well, see, it's just still, I think, under the first hour, as far as open is concerned. We'll see where it goes from here. New entrants in F&O at the bottom of the screen, and we'll continue to highlight that as we go along. It's a wrap from all of us here on Bazaar, but don't go anywhere. Our special segment, it's the economy on the other side. My colleague Lata will be in conversation with Pranjul Bhandari of HSBC to discuss their expectation from second quarter GDP, which is due today evening. Stay tuned, that's coming up.